Okay, well, hey, welcome back to overnightaccountant.com. As always, or as always so far, my name is Brett Hirsch. I'm your instructor for this course, where we are still discussing. This is part of our Realtors and Reducing Taxes comprehensive course, and we're still on expenses on Schedule C. Now, this section here is going to be a little long, a little complex. I hope you bear with me here, and I hope you're ready to learn some stuff because depreciation is reported on line 13. And it can be very complex and very confusing. And what makes this topic so important is not that just it's 114 pages long. If you look at the IRS publication 946 on how to depreciate property, that's 114 pages in about 8-point font. So single space. That's a lot of information, very complex and very confusing. One of the reasons it is so confusing or so important is that 1 year, as soon as you start depreciating an item, it will carry forward year after year and eventually will impact your return at some point where you either sell that asset or you dispose of it in some other manner. So it's very important you track. It has to be tracked from year to year. It's one of the reasons it gets so confusing. And one of the reasons we highly recommend getting a professional to prepare your return if you have very many depreciable assets. Be very, very careful with your software if you're doing the return yourself. Be sure to use the same type of software or make sure they can convert very easily each year and update, meaning, as I've said several times in this, there's several areas on your tax return, auto home office with actual expenses, and this area here with any carryovers, that if you do not update your current year software, bring forward your information from last year into the current year, you just messed up your tax return for every year going forward. So it's very important. What we're going to cover in this course is really what you need to know as a realtor. The home office deduction, depreciation on the home office if you're using actual expenses, that was covered in the home office section of this course. The auto depreciation was covered in the car and truck expense section under actual expenses. Check the library. We may end up with a course just on depreciation if you're really interested in learning more about this. Relatively rare for realtors to have very much depreciation on their tax return. Actually, it's usually very few. Usually it's a computer, some other small items, and maybe your vehicle if you're doing actual expenses. But this is a very complex area, and it's one of the longer sections of the course because we do want to cover, as I said up here, we want to cover what you need to know just so you really, we just want you to have a working knowledge of this so you can discuss it with your professional and also so you get an idea if you're going to buy something that's relatively expensive, what you have to do with it. So it's reported on Form 4562, Depreciation and Amortization. It carries forward to, that's where it comes from actually. So you're adding stuff into your software, that's where it's going to go or it should go there. The basic concept of depreciation, if you don't understand it, really it kind of makes sense when you think about it. Many items used in your business are not really used up immediately. Many of those items will really last more than a year. So the basic idea of expenses is something that you are consuming currently. Like if you buy advertising, for example, you're buying advertising for a certain publication on the internet and it's being used up. However, if you buy a longer lived asset, something that'll last several years, like say a computer or a car or a desk or something that'll last a number of years, what you want to do is divide up a little bit of that cost each year. So that's what you get to expense it. It can be complicated, but the basic idea is you understand. Those, and they're expensed over what we call depreciation over their class lives. This can be very confusing. We'll go over a little bit of basics here in just a little bit. I do want to make you aware of, however, that generally if you buy, say you buy a desk, for example, and you spent $250 on it, you're probably not going to have to depreciate that asset because it's under $500. So you may be able to expense that. But as a general rule, if it's over $500, you may need to depreciate that item if it lasts more than 1 year. And usually it's going to be something you can touch. Usually it's a tangible item that you're purchasing. It's an asset. Now there's also, I do understand there is a de minimis election that came out a few years ago with the IRS that you can actually expense up to $2,500 of assets. We're not going to cover that in this course. I just want to make sure that it does exist. If you're in that area and you're interested in that, you're really going to need to talk to a professional about that issue. Usually we make up for that with what we call the 179 expense, which we'll discuss near the end of this section of the course. Now, the class life, which we mentioned earlier, is based on the type of asset. Basically, we're going to be discussing what we call MACRS, and that is what and there's very many forms of depreciation. That's one of the reasons it gets so confusing when you're doing your own software. They're going to have a default that's probably MACRS, which is also known as the Modified Accelerated Cost Recovery System. That's what it stands for. So under MACRS, office furniture, cell phones, and most equipment are going to be depreciated over 7 years. How many people have a cell phone for 7 years? That just gives you an idea how 7 years. Computers, iPads, copiers, etc. are depreciated over 5 years. Most vehicles are also 5 years. Now software, if you purchase software, off-the-shelf software, that is going to be over $500, very rare, but you may have some software that you've purchased for your business that is going to last you longer, be usable longer than 1 year. It's depreciated, but we call that amortized over a 36-month period using what we call straight line depreciation, which basically means you're chopping it up and you're depreciating a certain amount each year. If you spend $100 for it and it's 36 months, you get right off a third of that, $33.33 each year, but it's usually based on the months. Okay. Amortization is basically depreciation for intangibles. Software, you could argue whether it's not, but my personal opinion is when software first came out, the IRS didn't know what to do with it, so they considered it an intangible at first, and they forced you to amortize it. Amortization is reported as an other expense on your tax return, so it doesn't really show up in depreciation. So if you happen to have some, and you notice it's not included in that line for depreciation, you need to look at the other expense column, probably on a subcategory that's going to be printed out with your IRS supporting statement that'll have amortization on there. Startup costs, remember, as we discussed in the beginning, they're amortized over 5 years. They're an intangible. And if you happen to, it's probably 99% chance, 99.9% chance, as a real estate agent, not a broker who bought a practice, but as an agent, you are not going to have goodwill, and you're probably able to write off your startup costs. Again, I just want to let you know, give you some basic information about depreciation to help you at least get an idea of the field in which we're talking about, an idea of what depreciation is and how it works. Most service businesses, such as realtors, really have very few depreciable assets. You're not doing heavy construction. You're not doing, you don't have a lot of heavy equipment. You're not doing manufacturing. You're really not going to have very many depreciable assets. However, most of the depreciable assets that you have are probably also going to be considered listed property. Now, these are items that the IRS knows, as we call their listed property. These are items that the IRS knows can be used for both personal or recreational as well as business use. So you may have a certain asset that you could use for personal use and then also say it's a business asset. Say a camera, for example. You have a nice camera, well, you can use that to take pictures of the kids or weddings or whatever you want to do with it. But you can also use it to take pictures of houses. The IRS knows that it can have a dual purpose. That's why they call it listed property, because they don't want you taking advantage of the rules. So the IRS requires proof of business use for these assets. And remember, only the business use percentage is depreciable. So if you have an asset that's used 80% of the time, 20% for business, only 80% of the value or what you paid for that asset is going to be depreciable, and that may change year to year. Another reason this becomes complicated. So enough with that section there. Let's move on to listed property. We're going to list a little bit more of the listed property here. Here's some of the types. Most passenger vehicles are considered listed property. We discussed that earlier. However, cameras, iPads are a big one. Video recording equipment, and even, let's say, drones for filming. Say you bought a drone and you're using the super cool camera they have on those things now to go around a house and take pictures of it so you can use it in your advertising on your websites. That can also be considered listed property because you could actually use that for personal. I'm not 100% sure about drones. That's why I kind of have it a question mark. I'd have to look that up, but my personal opinion is the IRS hasn't done it yet. They'll probably make those listed property. Okay, computers are also listed property. Now, here's an exception. If you have a computer at your home office or your regular office that is only used for business, you really don't have to prove the business use on that computer. So it's used at your home office and it's only used for business, quote unquote, only used for business. You don't have to worry about that computer so much. Now, if you're still using it for personal use, technically you are required to say it doesn't have to be listed, but remember, you only just depreciate the portion that's business use. Cell phones used to be listed property, but they're no longer listed property. So for let's say use, if you're paying over $500 for a cell phone, God bless you. But if it's less than $500, it's 100% business use. You can generally just expense that item. Okay, proving the listed property deduction. So let's say you have a vehicle, we discussed under auto expenses, you want to have a mileage log. Other items that may be considered listed property we discussed, you may have to prove the percentage of business use. And what they want to show, what the IRS wants to show, is some kind of record proving the amount of time as a percentage of total time used that was used for business use. So log the use of time showing total time used for the business and a percentage of time used for personal. So for example, let's say you have a camera and you're using it for personal and business. You may want to have the pictures on that on there, and there's probably a logging number. We don't want to get too technical here, but there's probably a logging number in that camera about how many pictures were taken. And say 1,000 pictures were taken that year. If you really want to get down to it, and the IRS wants to know, if you claimed 100% business use for that camera and you get audited, they may want to say, well, show me the log or show me some kind of proof, because the burden's on you, how many of those pictures were really for business use versus personal. You have the burden of proof in showing that. I just want to make sure you're aware of that. As always, I've said several times so far, regardless of the asset, only the business percentage use can be deductible. And your software is going to ask you about the percentage of business use for probably every asset. Some will be 100%, some of them may not be. As a good rule of thumb, there's a phrase in tax, and that is, it's a worldwide phrase in taxation, and that is pigs get slaughtered. So when we're looking at listed property, we generally want to give at least a little bit of wiggle room, because the IRS knows a lot of these items aren't used 100%. So if you can claim 90, 95, 85, something reasonable that you should argue with the IRS that makes sense, that's what you want to do, just to be safe. Now, listed property, we're going to discuss this a little bit later, but they can also qualify for what's called bonus and bonus depreciation and 179 expense. Whereas again, if it's used over 50% business use, we're going to discuss what bonus depreciation and 179 expense are near a little bit more further in the course. Okay, but if it has less than 50% business use, so if you have any asset on that listed property list that is less than 50% business use, you have to use what's called straight line depreciation using the alternative depreciation system. Now, I'm only telling you that because if you're using the software, you know where to plug in. If you have items that are less than 50% business use, again, that's going to be relatively rare as long as you call it a reasonable amount of business use and keep it over 50%. Now, if the business use falls of a listed property, this is, remember, we're still talking about listed property, items that can be used for both personal and business use. If the business use falls to below 50%, you may need to call recapture some of that depreciation. And again, as we said earlier, a lot of this depreciation, you have a lot of depreciable items on in your software. You may want to get a professional to do this. Again, I highly recommend it, because when you sell that item, we're going to discuss later, it carries forward year after year, and it can really create a mess. It's complicated. So that's it for that part. Let's move forward here. As we discussed earlier, we're going to talk about bonus depreciation. What is bonus depreciation? Well, certain new properties, you see that I have new underlined because it only applies to new property, may qualify for additional depreciation the year that it is purchased and placed in service. Now, this changes over time. For example, in 2017, this was 50%. Could be written off. You purchase a new item that qualified, which is most depreciable property, the course of the year that's new, that's used in the business, you would automatically get a 50% write-off up to a certain amount for the item placed in service that year. Now, as you can see, this goes down each year, but don't rely on that because Congress changes this every year, and oftentimes it's retroactive. So I want to make sure you're aware that you know just enough to know that it exists, and you may want to check on the percentage. And of course, if you're doing it yourself, your software will be able to do some of this for you. Only new property qualifies. Also with autos, as we discussed in the auto section, it's probably going to be limited unless you purchase one of those types of vehicles that qualify for a limited bonus depreciation. Okay, you must elect out of bonus depreciation. So this is automatic. So if you purchase an item, let's say you bought a desk for $1,000 and it qualifies for bonus depreciation. You purchase a new, likely it's going to qualify. $500 worth of that's going to be written off that year, but that may not be your best bet depending on your marginal tax rate. So in order to elect out of it, it may be more beneficial for you over time to write that off. When we're doing taxes for folks, we want to compare that and see, oftentimes you write that off is going to throw you to a lower tax break. So if you had a bad year, for example, writing off that bonus depreciation may actually, it'll save you a little bit of tax this year, but if you carried that forward for future years and got depreciation each year, that may really save you a lot more money because you're having a better year and your higher marginal tax rate. I hope that makes sense to you so far in this course, but you want to check it out and see where you're at this year versus where you might be next year. And you can elect out, and generally you have to elect out of all types of property, or you can pick certain types of property to elect out of. Little much for this course, I know, but you want to make sure you're aware that you can do that. Now you may have to recapture later, and this could get highly complex, if business use falls below 50%, particularly on listed items. So now let's go into what we discussed earlier, or mentioned earlier, 179 expense election. Now this is an area, we do use this quite often for folks if it benefits them on their taxes. This allows taxpayers to deduct an elected amount on an asset when they place it in service. It's a very good deduction. It usually applies to tangible personal property only. Same with the bonus depreciation, by the way. It usually does not apply to real estate. So, you know, your home office, you're not going to be able to 179. But a lot of the tangible personal property you purchase can qualify, and that can even include box software. Now, used property, a good thing for this is used property qualifies. So if you purchased a used desk, for example, or a used car and it otherwise qualifies if it meets the other criteria we discussed under auto expenses, you can elect to write off an amount of that. You can write off the whole thing. And there's limits. And I'm not going to discuss the limits in this because they range anywhere from $25,000, which sometimes that's what it is for a car, up to $100,000, and Congress changes this all the time. But for the past 10, 15 years, it's been in play every single year. And for relatively middle-class taxpayers who aren't really large, they usually don't reach that limit. Unless you're buying an asset that's worth $40,000, $50,000 as a contractor, say you're buying a new backhoe, a new big dump truck for your business. I usually don't worry about that too much. Now, this is a good hedge against IRS challenges for small business owners. So if they claim that something should have been depreciated that you wrote off and you didn't depreciate it, within a certain limit, you could go back and say, well, hey, we can just 179 that. So it's really a good hedge against IRS claims that you should have what's called capitalized something that you didn't. Most small business owners don't run into this very often, particularly if you have so few assets as realtors do. Just want to make you aware. Personal property converted to business use does not qualify. We're going to talk about converted property in a few minutes, but items that you have, say you go into business and you have a desk, you have furniture, you have a computer, items that you bring into the business when you start, or an item that you have like an iPad or something, whatever you have that you start using for business, or make it only business use, that does not qualify for the 179 expense election. Also, you must purchase and place that item in service. So if you bought it in November of last year, but you don't start using that asset, say, until March of the next year, it does not qualify for 179 expense because you have to both purchase it and start using it, what we call place in service, in the same tax year. Important for you to remember that. If you're purchasing items near the end of the year, make sure you start using them. If you're trying to save taxes, like say December, make sure you start using that item in the same tax year. Okay, let's discuss a little bit about converted items, which I just mentioned a moment ago. Remember, and this is often a lot of folks forget when they go into business, or even when they're already in business and they start using some personal items that they've used for personal use for so long, that if they convert those items to business use, they can write those items off, or at least they can depreciate them. Let's say you have a camera you use for personal, now it's in the business. Office furniture, computer, your drone, whatever you might use, but you're converting it to business use. Remember those items because a lot of folks forget, and a deduction's a deduction. Every $1,000 deduction is going to save you upwards of $40 to $45. Every $100 is going to save you upwards of $40 to $45 on your tax return. So remember that. However, these items must be depreciated over their class lives. No bonus depreciation allowed, so you have to depreciate those items. You also remember you have to use, well, we haven't covered this yet, but you have to use the lower of the adjusted basis, which is basically what you paid for the item when it was new versus the fair market value of the asset now. So this often will limit your write-off, and it's very important you remember that because the IRS, if they become aware of that, they're going to want to see how you did this. So let's go through an example here. Let's say you converted a desk to business use. You paid $800 for the desk 3 years ago, and now you've moved it to your home office and it's in your home office. Okay, so it's an item that you converted to business use that you originally bought personally. Let's say it's currently worth $450. Now you see that's under $500, but still, because it's an item you converted, you just can't expense that. You have to depreciate it. So you're going to have to depreciate using the $450 value. That's the lower of the adjusted basis or the fair market value. Instead of the $800, you must use the $450. So I hope that makes sense there. What I want you to do, though, if you do that, you have some form of proof of what the desk is worth at the time you do that. Something, just jot in the notes, find something online at a used sale or something like that, just to show. Or sometimes you can even get away with showing, this is what I purchased new. If I depreciate this way 3 years later, this is what it'll be worth now. It's not as good, but you just want to have some kind of proof to show, reasonable amount that you said that the asset was worth at that time. Okay. Again, as I mentioned earlier, no expense on this. So in items that are converted, you just can't write them off. Now, small items that you purchase, say, like staples, basic office supplies, those things, if you have a receipt for them, yeah, go ahead and write those off. However, converted items must be depreciated, not expensed. The $500 limit doesn't apply, as I mentioned earlier. Remember, only the percentage of business use can be depreciated, so I want you to be safe. So, all right, now here's where the stuff gets, if you're not confused by now, this is where the stuff gets really fairly complicated with regard to depreciation. The sale of depreciated items. So we'll make sure you're aware this is one of the reasons it's so complicated and why we really recommend professional if you have a bunch of assets, because a sale of a depreciated asset can create what's called both ordinary income and capital gain income. This is complex, but here's the general concept. When you get to expense or you get to depreciate an item over a number of years, that amount of depreciation, it gets to offset your ordinary income. So if you're in a marginal, I use 25% a lot because that's kind of like where most of us fall in our tax return, the middle class. You're not earning a little bit, you're earning somewhere between taxable income, say around between 70 and 150, 160, something like that. You're going to need 25 to 28%. 25 is a good middle of the road number there. So you got to write off every $1,000 that you depreciate an item. You got to write off $250 of taxes, which you reduce your taxes by $250 each year. You got to reduce that, or you got to write that off from ordinary income. So if you think about it, it makes sense. When you sell that item, if you have a gain, you get to pay back, or you have to pay back a portion of that ordinary income. So that depreciation, if it's included in that gain, you have to pay back as ordinary income. That's what we call recapture. So let's go through a couple definitions here. We're going to give you an example, but I want you to know what we're talking about. Beginning basis. Now, we say basis. That basically means the general, very general rule, just what I used to explain to people. That's going to be the lesser of the purchase price, what you paid for the item when you purchased it, or the fair market value when you placed it in service, which we discussed earlier, particularly with converted items where you run into this a lot. So your beginning basis is going to be the purchase price or the fair market value when you placed it in service. Adjusted basis, okay? This is really basically our terms of it, as we use it just as an example here, the concept to get you to understand what it is. That's going to be your beginning basis, generally the purchase price, okay? Beginning basis minus the depreciation that you claimed over the years before you sell it. So at any given time, if you paid $1,000 for an item, and let's just say, for example, you're writing off $1,000 a year of it, and you have it for 3 years, you've got to write off $3,000 out of that $10,000. So the beginning basis was $10,000. You've got to write off $3,000. So your adjusted basis is now $7,000. That is what we use to calculate your gain or loss on a sale, is that $7,000. That's beginning basis minus depreciation claim. Sales price is kind of easy to get. It's what you sold something for. Sales price you sold the asset for. Ordinary income, as we talked about, that's income that is going to be taxed at your marginal tax rate. That basically means wherever you're at on that return, we have a marginal tax rate system. I use 25%. If your additional income coming into your household is taxed at 25%, plus state tax, I hate to tell you, it's going to be taxed at your marginal rate of 25%. Now, capital gains, which a lot of us are after for most things, is you get a tax break on that. And most of it's going to be long-term. Usually buy sell an asset same year is kind of, that's a different issue I'm not going to talk about in this course. But most of you have the asset over a year and you sell it, that's usually going to be taxed at 15% unless you're a really, really high earner, and that would be taxed at 20% as the law stands now. It's been that way for quite a number of years though. So let's use an example. Let's say you buy equipment for $10,000. You've had it for a number of years and you've depreciated $6,000, or if you've won 79 or bonus depreciation, but regardless, you've written off, you've enjoyed the tax benefit of writing off $6,000 of that asset. So what's that make your adjusted basis? That makes your adjusted basis $4,000. That's $10,000 what you purchased the equipment for minus the $6,000 of depreciation you've claimed so far. So let's say you sell that asset for $8,000 a few years later. So you're going to have a gain. So you take your $8,000 sales price minus your $4,000 right here, adjusted basis, gives you a $4,000 gain. Okay, I hope that makes sense to you. It's relatively cut and dry, but because of the way the rules are I just mentioned, you're going to have to recapture that $4,000 is going to be taxed as ordinary income because you claimed more than $4,000 of depreciation. You claimed $6,000. So up to the point where it's a $6,000 gain, you're going to have recapture. So that's taxed at a marginal tax rate, 25% we're using for example, maybe lower than that, higher depending on your specific situation. But anyway, 25% what we're using there. So let's go through another example. Now let's say you bought that equipment for $10,000, but somehow magically, which is very, very rare, that asset has actually appreciated in value, meaning that equipment is now worth more than what you paid for it originally. Going to be rare, but you see this with real estate, and these same rules apply with real estate, by the way, if it's used in business or as a rental, for example. Let's say you sell the asset at $12,000. Okay, you got a total gain now, $12,000. Remember your $4,000 adjusted basis there. That gives you a gain of $8,000. Well, how's that treated? Remember, you claimed $6,000 of depreciation. You paid $10,000 for it. You got to write off $6,000, so your adjusted basis ended up being $4,000. So $6,000 of that gain, the amount of depreciation you claimed, is recaptured at your marginal tax rate, and then you have capital gains of $2,000. So we really, what we call bifurcate, or we have to divide up that $8,000 gain into recapture, and then the remainder is taxed at capital gain. Often these assets will be reported on Form 4797. Just so if you're doing through your own software, you can look at it, or if you have a professional prepare it, you should see these sales show up on there. So that's it for that part of this course. But now let's go over some notes. These are some items I want to make you aware of with regard to depreciation before we move forward in other sections. So again, highly recommend a professional for this. I want to give you some advice here. If you are doing your own software, be very, very careful. As I said, most errors occur here. There's a couple areas on a tax return that folks do themselves. I very rarely see them correct. One of them's auto expense, actual expenses. The other is going to be home office deduction, actual expenses, not standard or the square footage you can take on your home office. I'm talking about actual expenses. And then the third one is going to be this, depreciation. This is where most areas occur, and often it occurs when you enter the data. How the data is entered, because software, you really can't simplify this enough so people understand it well enough. So sales and trade-ins, okay? When you sell something, we just discussed, it can be very complicated. Trading in a vehicle can be highly complex. Trading in any kind of equipment can be highly complex. Notorious for errors. Again, make sure you use the same software each year and you update from the previous year. If you get a professional, excuse me again, remember to print out the depreciation schedule from the prior year or from the previous year's return so they know what the basis of your assets are. Very important that you give them that information. Now, a good thing is depending on your locality and how your property is taxed, the less items that you depreciate, the less items you capitalize, the less items they're going to be subject to your personal property tax. So we want to write off as many assets as we can if and when we can. 179 and bonus might not get you out of that, but if you can expense an item as opposed to putting it on your tax return, and oftentimes for your personal property taxes for business, I know in our area you have to send in a depreciation schedule. If it doesn't show up on there, you're going to save yourself from taxes most likely. Risky items, remember to have proof of listed property. bonus depreciation and 179 expense. Autos is another risky area, particularly when you're claiming actual expenses. Home office also can create a mess with depreciation, claiming actual expenses. So that's it for this section of the course. Congratulations, you've made it, and I've made it. I haven't coughed too much in this section. It's a long one, and we'll see you in the next section.